It has officially begun. The most violent, chaotic, and historic trading session in the history of the silver market just started, and it didn't start in New York. It didn't start in London. It started in Shanghai, while the Western world was asleep. If you are waking up in the United States or Europe, you are waking up to a different world. You went to sleep with silver trading at $85. You woke up to a gap on the chart that looks like a glitch, but it is not a glitch. It is a reckoning. At exactly 9 p.m. Eastern Standard Time, the Shanghai Gold Exchange, SGE, opened for business. Within the first 15 minutes, the volume was triple the average daily volume. The smart money in the East didn't just buy the dip, they ate the entire order book. The price ripped through $88, then $90, then $95. And finally, it tagged $98 per ounce. This is the moment we have been warning you about for 3 years. This is the moment where the paper price in the West loses control and the physical price in the East takes over. The $98 print in Asia is not just a number. It is a declaration of war against the COMEX short sellers. Why does this matter? Because the US markets are about to open and the arbitrage gap is now roughly $13. Think about that. You can theoretically buy a contract in New York for $85 and sell it in Shanghai for $98. This is free money. It is a risk-free trade for the banks. But there is a catch. To execute the trade, you need physical metal. You cannot sell a paper promise in Shanghai. You have to deliver the 1 kilogram bars, and the banks in New York don't have them. So when the US market opens in a few minutes, we are going to see absolute chaos. The banks will be forced to buy futures to close the gap. They will be forced to chase the price higher. They are trapped in a limit-up scenario where there are no sellers, only desperate buyers trying to cover their naked positions. The media will try to tell you this is a speculative bubble. They will tell you it's retail mania. Do not believe them. This is not speculation. This is evacuation. The East is evacuating the US dollar and moving into hard assets at any price. They don't care if silver is $98. They care that the dollar is dying. The silence from the bullion banks is deafening. Usually by now, they would have smashed the price back down. They would have used the London fix to cap the rally, but they can't. The volume in Shanghai is too strong. The physical demand is too real. The Maginot Line of suppression has been flanked. If you are holding physical silver, do not sell. Do not let the volatility shake you out. The $98 price is just the beginning. It is the first time the true value of silver has peered through the curtain of manipulation. We are witnessing the uncoiling. The spring has been compressed for 40 years, and today it snapped. To understand why the US markets are opening in chaos, we need to deep dive into the mechanics of the arbitrage nightmare. This is the engine that is driving the price to $98 and beyond. The global silver market is supposed to be efficient. If silver is $85 in New York, it should be $85 in London and $85 in Shanghai. If there is a difference, traders buy the cheap one and sell the expensive one until the prices equalize. This is economics 101. But right now, the mechanism is broken. The price in Shanghai is $98. The price in New York is $85. Why hasn't it equalized? Because the arbitrage loop requires physical delivery. To profit from this gap, a bank like JP Morgan or HSBC has to buy a futures contract in New York, stand for delivery and take the 1,000-ounce bars out of the vault, put them on a plane to China, sell them on the Shanghai Gold Exchange. The problem is, step number 2, they cannot get the metal. The registered inventory at the COMEX, the metal available for delivery, has plummeted to historic lows. We are hearing reports that the loadout queues are backed up for weeks. If you ask for your silver today, they tell you to come back in March. This means the arbitrage is broken. The price in Shanghai can go to $100, $20, $150, and New York can stay stuck at $85 because the bridge between the two markets has collapsed. This confirms that the COMEX is a zombie market. It is trading a phantom asset. It is trading paper claims on silver that doesn't exist. Shanghai is trading the real thing, and the real thing is worth $98. What happens next is the drain. Even though the arbitrage is difficult, it is not impossible. Every available ounce that can be moved is being moved. The vaults in London and Zurich are being emptied to feed the Shanghai Express. The West is being stripped of its strategic resources. This is a geopolitical catastrophe for the United States. Silver is a strategic metal. It is used in Tomahawk missiles, satellites, and fighter jets. We are letting our geopolitical rival drain our supply because our bankers wanted to suppress the price to protect the dollar. They sold our national security for a quick profit on a short trade. Now, the bill is due. The Shanghai put is no longer just a floor, it is a vacuum. It is sucking the liquidity out of the West. When the US market opens, the traders know this. They know that every time they sell a contract, they are selling it to an entity that will demand delivery and ship it to China. The shorts are terrified. They are realizing that they are on the wrong side of the greatest wealth transfer in history. They are shorting a metal that the world's manufacturing superpower is hoarding. It is a suicide mission. So what happens when the opening bell rings in New York? We enter the gamma trap. The banks rely on algorithms to manage their risk. These algorithms are programmed with historical data. They know that silver is volatile, but they expect it to revert to the mean. They expect that if the price goes up 5%, it will come down. But the move to $98 breaks the model. The banks have sold millions of call options with strike prices at $90 and $95. These are bets that silver will stay below those levels. With silver trading at $98 in Asia, those options are deep in the money. This forces the banks into a forced buying loop. To hedge their exposure, they must buy futures contracts. The more they buy, the higher the price goes. The higher the price goes, the more they must buy. This is the gamma squeeze. It is a mathematical feedback loop that creates a vertical line on the chart. Usually, the banks stop this by smashing the price. They dump paper to kill the momentum. But they tried that yesterday at $85 and it failed. They tried it in the pre-market this morning, and the Asian buyers absorbed it. The algorithm is now confused. It is trying to hedge, but there is no liquidity. The order book is empty on the sell side. Who in their right mind would sell silver at $90 when Shanghai is paying $90? No one. So the banks are bidding against themselves. They are chasing the price up, trying to find a seller, but the only sellers are in China, and they are demanding 100 pluses. This is why the US market will open in chaos. We might see a limit up halt. The exchange might pause trading to cool off the market. Do not be fooled. A trading halt is not a solution. It is a confession. It is the exchange admitting that the price is out of control. If they halt the market, it traps the shorts. They cannot get out. They have to sit there and watch the price in Asia go to $105 or $110. The panic builds behind the closed doors. When the market reopens, it doesn't gap down. It gaps up higher because the panic is more intense. We are watching the death of the paper market. The COMEX cannot function if it cannot track the real price. If Shanghai is the price discovery mechanism, then COMEX is just a side betting parlor. And the house is broke. While the bankers are sweating in their suits, the real panic is happening in the boardrooms of the industrial giants. We need to talk about Samsung, Tesla, and the solar industry. The $98 price tag is a signal to them that the supply chain is seizing up. These companies operate on just-in-time delivery. They don't hold months of inventory, they trust the market. But when they see the price gap $13 overnight, trust evaporates. A procurement officer at a solar company sees $98 and thinks, if I don't buy now, will it be $120 tomorrow? Will there be any metal left? This triggers panic hoarding. They shift from just-in-time to just-in-case. We are seeing evidence of this right now. The industrial buyers are bypassing the COMEX entirely. They are calling the refineries directly. They are calling the mines directly. We will take your entire production for 2026. Name your price. This is the off-market drain. It removes supply from the public markets before it ever gets there. The demand for silver in industry is inelastic. If you are building a $50,000 electric car, and the silver cost goes from $20 to $100, do you stop building the car? No, you pay the price. The cost of stopping the assembly line is millions of dollars an hour. So the industrial buyers will pay $98. They will pay $150. They will pay whatever it takes. This creates a concrete floor under the price. The banks can try to manipulate the paper price down to $80, but if Tesla is paying $90 in the physical market, the paper price is irrelevant. We're entering the phase where force majeure becomes a daily headline. Refineries will declare they cannot meet their contracts. Mines will declare they are sold out. This is the supply chain seizure. It is the moment where the physical reality crushes the financial fantasy. So what does this mean for you, the guy trying to buy a few ounces at the local coin shop? It means you are entering the unobtainium phase. The $98 price in Asia has broken the retail market in the US. If you walk into a coin shop today, you will see one of two things. Sold out signs. The dealer has pulled their inventory. They are not selling until they know what the real price is. They are not going to sell to you at $85 if the replacement cost is $98. Premiums that make your eyes water. You might see spot price at $90, but the price for an eagle is $130. The spread has blown out. We are witnessing the death of the spot price as a useful metric. Who cares if the TV says silver is $90 if you can't buy it for less than $120? The ghost number is the price on the screen. The street price is the price you pay. And the street price just went vertical. This creates a retail panic. People who were waiting for a pullback are now rushing to buy. They realize they missed the bottom. They are chasing the price. This FOMO, fear of missing out, adds fuel to the fire. It drains the last few ounces from the retail pipeline. Dealers are now going bid only. They will buy your silver, but they won't sell you any. They are hoarding it too. They know that cash is trash and metal is king. When the dealers become stackers, you know the game is over. If you're holding physical silver, you're holding the only asset that matters. You are your own central bank. Do not be tempted to sell into this chaos. Oh, it hit $90. I should take profits. No. You do not trade the family farm for a pile of paper that is burning. You hold. You wait for the system to break completely. You wait for the ratio to tell you when to move. So here's the verdict on this historic day. It is happening. The dam has burst. The $98 print in Asia is the water rushing through the breach. The U.S. markets opening in chaos is just the symptom. The disease is 40 years of debt, 40 years of printing, and 40 years of suppression. The cure is higher prices, much higher prices. Where does the smart money go next? If you can't buy physical because it's unobtainium, you rotate into the miners. The mining stocks are about to have their dot-com moment. At $98 silver, a miner with a cost of $20 is making $78 profit per ounce. Their margins have expanded by 2,000%, but their stock prices are still stuck in 2024. Wall Street hasn't done the math yet. They are asleep at the wheel. This is the miner pivot. This is where the 10x, 20x, 50x gains are hiding. We are buying the unhedged miners, the ones in safe jurisdictions, the ones that actually have metal in the ground. When the Q1 earnings come out and these companies announce dividends that are bigger than their entire market cap used to be, the stampede into this sector will be biblical. And finally, the exit strategy. We are watching the gold to silver ratio. It is crashing down. It was 80, then 60, now it's heading for 40. We wait for 30.1, we wait for 15.1. That is the signal. That is when we swap our volatile silver for stable gold. We lock in the purchasing power. We trade the industrial panic for the monetary safety. But for now, we ride. We watch the U.S. open with popcorn. We watch the banks squirm. We watch the algorithm break. This is the day you prepared for. This is the day the stackers were right and the skeptics were wrong. The $98 signal has flashed. The chaos has begun. Hold the line. Subscribe to the channel. We will be live streaming the market open. You do not want to miss the fireworks. Class dismissed.